If you've ever opened your inbox to that message, "We've reviewed your account and we can no longer support your business," you know exactly how it feels. One day the sales are flowing, the next your payouts are frozen, your customers' cards are getting declined, and the only explanation is a termination letter. No name, no number to call, just "You're too risky." Here's what nobody takes the time to explain. High risk is not a judgment about you or your character. It's a category, a box on a form inside a bank. And once you understand how that box gets checked, you stop being at the mercy of it. You can plan around it, price for it, and build a payment setup that actually lasts. Welcome to The Payments Guy. I'm Frank Sena. I've spent over a decade in payments, underwriting merchants, working with processors, and helping business owners find real payment solutions when the mainstream options turn them away. This show isn't about hacks or shortcuts. It's about understanding how the payments industry really works. Because when you understand it, you take control of the payment side of your business instead of letting it control you. Today, we're breaking down one word that quietly decides whether you get approved, how much you pay, and whether your money shows up on time. That word is risk. What it means to a bank, why you might be in that risk bucket, and exactly what to do about it. Let's kill the biggest myth first. When a bank calls your business high risk, they're not saying you are dishonest. They're not saying your product is bad. They're making a prediction about one thing and one thing only. How likely is it that money will have to flow back out of the bank after you've already been paid by them? That's the whole definition. Think about what actually happens when you take a card payment. The customer's bank pays you now, but that payment isn't truly final for weeks, sometimes months. During that window, the customer can dispute the charge. Your business could close before you deliver, a product could show up broken or not at all. And if any of that happens and you can't cover the refund, guess who's left holding the bag? Your merchant bank that processes your payments. So before they ever approve you, they're asking one question. If this goes sideways, how much could we lose and how likely is it? Risk to a bank comes in two buckets. The first is financial risk, the straightforward chance that they take a loss. The second is reputational and regulatory risk, the chance that being associated with your industry brings them heat from card networks like Visa and MasterCard, regulators, or their own compliance department. And here's the key that trips people up. A completely honest, well-run business can land in the high-risk category purely because of that second bucket. A legitimate CBD company, a real travel agency, a growing supplement brand. The category itself carries more disputes or more legal gray area, so the whole category gets labeled as risky. It's not personal, it's math on a spreadsheet. And like it or not, you are a row in that spreadsheet. Banks have a shorthand for sorting you. It's called your Merchant Category Code, or your MCC. It's a 4-digit number that says what kind of business you are. Some of these codes are flagged as elevated risk from the start. So before a single human being reads your application, that code has already told the system which lane to put you in. So what actually moves you into that high risk column? A handful of concrete factors, and most of them have nothing to do with how good you are at running your business. Number one, and it's a big one, your industry. Some verticals are classified as high risk across the board. CBD and vape, nutraceuticals and supplements, credit repair, travel, multi-level marketing and direct sales, diet and weight loss, subscription and continuity building. That's a big one. Telehealth, debt consolidation. If you're in one of these spaces, you can have a spotless record and still get labeled high risk on day one, simply because of the industry you're in. Number two, your business model, specifically how and when you charge. Do you offer your customers a free trial that rolls into a subscription? Bigger transaction sizes mean bigger potential refunds. Recurring billing, large transactions, and free trials. Three of the most common reasons a business gets the high risk label, even inside an otherwise ordinary industry. Number three, your history, yours and the business's. Thin credit, poor personal credit, or a track record of elevated chargebacks all raise that big red flag for the bank. And this one is the stickiest because your payments history follows you from bank to bank. We'll come back to why that matters in a minute. Number four, regulation and the moving target of the law. If your industry touches health claims, money movement, supplements, anything where the rules shift from state to state or from year to year, banks factor in the cost and the danger of keeping up. When the legal ground can move under the bank's feet, they charge you for that uncertainty. Now, notice what is not on that list. How ethical you are, how much your customers love you, how good your product actually is. Those things are everything for your business, but they are not what the risk box measures. That's the disconnect that blindsides good business owners. You know that you're legit and your business is legit, but the form doesn't have a checkbox for legit. It has a checkbox for how likely is a loss. So when you submit your merchant account application, what is the underwriter actually doing? They are building a risk profile on you. They pull your personal credit and often your business credit as well. They look at your processing history. Have you been terminated before? Why? They're really looking for chargeback history. They check industry databases. They study your website. Is your refund policy clear and easy to find? Are your terms and conditions posted? Is it obvious what the customer is buying and what they'll be charged and how often? They estimate your average transaction and monthly volume and compare those numbers against what's normal for your industry. Here's the practical takeaway, and it's one you can act on today. A huge number of approvals are won or lost on whether your website and your paperwork tell one consistent and honest story. If your projected volume matches your history, your billing descriptors are clear, your refund policy is right there on the page, you look like a lower risk business to the bank and you get approved with better terms. Sloppy, inconsistent, or hidden information does the opposite. You have more control over this than you think. Let's be honest about the price tag because it's real. Being classified high risk usually means three things. Higher processing fees. You'll pay more per transaction than the low risk retailer down the street. A reserve requirement where a portion of your sales gets held back by the merchant bank as a cushion against potential losses. The type and the size of that reserve depends on your risk profile. And stricter underwriting. More paperwork, more scrutiny, sometimes even caps on how much you can process. That reserve requirement catches a lot of business owners off guard. Let me make it concrete. Say you're doing $100,000 a month and the underwriter assigns 10% rolling reserve to your account. That's $10,000 of your own money sitting in their account every month and released back to you on a delay. It's not lost. You do get it back, but if you didn't plan for it, that's a serious hit to your cash flow. This is exactly the kind of thing you want to understand before you sign, not discover after. But here's the part that matters the most, and it's the part my whole business is built on. High risk does not mean unbankable. There is an entire ecosystem of banks and processors that specialize in exactly these high-risk categories. They're not reluctantly tolerating high-risk merchants. They've built their entire underwriting model around supporting them. They want this business. The mistake I watch owners make over and over, trying to force themselves into a mainstream one-size-fits-all processor that was never designed for a high-risk brand with a subscription. They get shut off without warning and then treat that shut off like a verdict on their whole company. It isn't a verdict. It's a signal that you were in the wrong lane the entire time. The right move is straightforward, even when it isn't always easy. Get matched with a bank that already says yes to your industry. Set the account up correctly from day one. The right category code, honest projected volumes, clear billing descriptors. Then keep your metrics clean so you stay approved for the long haul. And don't put everything on one processor. Relying on a single banking relationship is how businesses get wiped out overnight when that one relationship ends. Spreading across more than one bank is exactly why a network of options matters so much in the high-risk space. So here's what I want you to walk away with. 1. High risk is a category and not a prediction, not a character judgment. The bank is asking one question: how likely is a loss? That's it. 2. You're usually in that high risk bucket because of your industry, your billing model, or your history. All things you can see clearly and plan around. 3. There are banks built specifically to approve and support high-risk merchants. So your goal isn't some trick to look low risk, it's finding the right match and managing that relationship on purpose. That matching, connecting high-risk businesses with the banks that actually want them, is the entire job at PayDiverse. A network built over a decade, dozens of bank solutions across these exact industries, and approvals for businesses the mainstream turned away. If you've been declined or shut off, that is not the end of your story. It's the starting point. Head to paydiverse.com and let's find the right long-term home for your business in payments. I'm Frank Sena, and this is The Payments Guy. I'll see you next time.